There's no question where it's being effective, Safrina. The headline inflation number is down from 9.1% to 4.9%, which was certainly better than expected. But I think the most important number in this report was the shelter number, because month on month, shelter rose just 0.4% compared to the previous month, which was 0.6%, compared to the month before that, which was 0.8%. This is a major factor in the CPI, a major weighting in the CPI. And the fact that this metric has started to roll over is very, very important, because that means in coming months, due to the base effects of a year ago, we're going to see a steep, steep drop in inflation moving forward.
And moving on from the high interest rate, do you think after, this has been a great success, the inflation rate has been plummeted to 4.9%, do you think, and also do you also see the terminal rate will be around 5.5% or 5.75%? The market has already speculated about the terminal rate of Fed fund rate. Have you already seen it?
How about 5.10%, right where we are right now? As a matter of fact, yesterday, the stock market was declining midday. The Dow Jones was down about 300 points. And at 2 p.m., there was an article in the Wall Street Journal by Nick Timiraos, who is known as the Fed Whisperer, meaning has direct contact with the Federal Reserve. And he said that it's likely they're going to take a pause over the summer as they weigh the banking stress and they weigh the impact of their previous tightening. So I think we're done. And as a matter of fact, as you look through the different components of the CPI report yesterday, now 40% of those components are actually in deflation, not inflation. So with the most stubborn one, which finally started to come down because leases work on a 12-month lag, which is shelter and owner's equivalent rent, I think we're going to see it continue to come down, the lagged effect. And because we saw Timiraos publish that, more likely than not, what Jay Powell referenced in his press conference last week, where he said we may be at that level, and then Timiraos confirming it in the Wall Street Journal yesterday, bodes very well that they could in fact pause here for some time. If they need to go back in a few months, if the data doesn't come down, they'll do that. But I think we're going to see the data come down materially, in which case they're done at this 5.10, which was their last published terminal rate.
So it's great that the Fed Whisperer says that they're going to take the break around this summer, but eventually we're going to see the data. 4.9% is still far away from the 2% as the the Federal Reserve target. And on the other hand, if we see the data from the payroll, it's still quite high in around 253,000 compared to the consensus, which is around 180,000. What do you think about it?
Well, I think this bodes well for the soft landing scenario where you have jobs are still good, but the excess savings is coming down now. It's only $500 billion, down from $1.5 trillion. So more and more people, as they spend down their savings, are going back to work, which is very important. The labor force participation rate, which came out last Friday, was at 62.5%. That's been steadily moving up over the months. And what that means is more supply of labor is coming into the market, which means wages will stop going up. They don't have to go up so much to attract labor. And that's going to offset the increase in inflation while at the same time putting more people back to work. And that does create the perfect scenario of a soft landing, provided the Fed does, in fact, stop at these levels, as we were referencing.
The soft landing scenario is even clearer after this. And as you see the moving numbers, the dynamics going into the right direction, when are we going to see the inflation rate in the U.S. will ultimately reach the 2% target?
Not for a long time. So the idea of setting a target of 2%, which is unachievable in the short term, is the objective is to pin long-term inflation expectations. That's very important for consumer behavior because you don't want a wage price spiral where people believe prices are going to go up and up and up and they start buying and buying and buying. So they continue to put that target out there over time, they emphasize, which could take 3 to 5 years. And that helps people be grounded in the short term and not act irrationally in the short term. What we saw the last time we had debt to GDP of 120% was post World War II. They let inflation run above trend about 3 to 5% for 3 to 5 years over that period. And it slowly came down, and we inflated away some of our debt exposure.